Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our Q&A webinar. I want to cover a few things about STC before we get started. I do want to mention that we are a retirement plan administrator only, so we do not provide legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't endorse or represent any particular investment opportunities, and I may be talking about some of those during this presentation. So we do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to start with some general information about self-directed retirement accounts. I'm going to cover some investment options that are available to you in a self-directed account. We're going to talk about the guidelines that are required that you must follow for investing in a retirement account. And then I'm going to give you a bit of information about the account structure that we offer our clients at STC. I'll go through the detailed services that we offer our clients, and then we'll go through your questions. So first off, to get started, I do want to talk about what is a self-directed retirement plan. So when we use that terminology, we are suggesting that you have a plan working with an entity that permits you to choose any type of asset that is allowed by law. So that includes a lot of different types of assets. You can choose things that some consider non-traditional assets like real estate in your retirement account. It also means that you're going to manage or make the decisions related to the investments in your retirement account. So, for example, if you do decide you'd like to own a piece of real estate in your plan, then you would decide if you were going to hold that property for a rental, what the rental rate would be, if you were going to fix it up, put a new roof on, update the appliances. You would make the decisions related to the investments in your retirement plan. And so ultimately that means that you have more direct control of the investments than you do when you're simply investing in stocks or bonds, stocks of a company where you have a little control over the decisions that are made at the corporate level that might affect the value of that stock. So with self-directed investing, you choose the assets you want, you make the decisions related to those assets. Now, there are a number of different retirement plans, and I'll just talk about a few of them here, the most common ones and the ones that most of our clients hold. And the first two I brought out onto the screen are IRAs, a traditional IRA and a Roth IRA. These are similar in that their maximum annual contributions are identical. Now, the maximum contributions changed in 2023. So for both of these accounts in 2022, you could contribute up to a maximum of $6,000 of your earned income into one of those accounts. If you were 50 years or older, you could add a catch-up contribution of $1,000 for a total of $7,000. Now, in 2023, these amounts go up by $500. So the maximum contribution is $6,500 with a catch-up of $1,000, so a total of $75,000. So that's for earnings in the year of 2023. So if you have one of these accounts and are making contributions for 2022, the maximum will be $6,000 or $7,000. Now, the difference between the two accounts is significant. When you make a contribution into a traditional IRA, like most retirement account contributions, those monies are contributed pre-tax. In other words, let's say you're contributing $6,000 into a traditional IRA for 2022. You can deduct that $6,000 from your taxable earnings for your income taxes for 2022. So the contribution is made pre-tax. That is not the case with a Roth IRA contribution. Roth contributions are made post-tax. So, for example, I have a Roth account personally, and I'm going to make my contribution, but I won't be able to deduct that from my taxable earnings this year. I will pay taxes on my Roth contribution. So then where's the benefit of this type of account? Well, the benefit is that once you have held a Roth account, it's been open for 5 years, 60 months, and you begin taking distributions that are qualified. In other words, you've reached 59 and a half, which is the IRS's retirement age for taking qualified distributions. And there are some other exceptions to this, but when you take qualified distributions, those distributions are not included in your taxable income, whereas a distribution from a traditional IRA would be. So what that boils down to is, in a Roth account, the earnings on your contributions, all the money that is earned over time, as long as it's taken as a qualified distribution, that earning will never be taxed. It's not included in your taxable income. So that is the benefit of a Roth IRA, of Roth contributions. Another type of plan that some small business owners, some partnerships have is a SEP plan. This is a simplified employee pension plan. You can be a sole proprietor and have a SEP plan, in which case you are both the employer and the employee. Or you can be a small business owner and have this for your employees. It does afford larger contributions than a traditional or a Roth, because this is a plan that is on a business. So with SEP contributions for 2022, this did also increase for 2023. In 2022, you could contribute into a SEP plan a maximum of $61,000 of the earnings of the business that this plan is on. Maximum $61,000. In 2023, that's going up $5,000 to a maximum of $66,000. So if you are a small business owner, maybe you're a sole proprietor, you might, and you don't have a plan for your business, you might want to consider a SEP plan, because that will give you larger allowable contributions into your retirement plan. Next type of plan I bring up is a simple plan, savings incentive match plan. I've seen this used by, again, some sole proprietors. I've seen it used by some partnerships, and it has some different terms. You can talk with your accountants, about, if you have a business, which type of these plans might be best for you. It has contribution limits in 2022 of $14,000 with a catch-up provision of $3,000, so you can go up to $17,000 if you're 50 years or older. For 2023, those numbers are going to go up. You can contribute into a simple plan, $15,500, so an additional $1,500, and a catch-up contribution, bringing a total to $19,000. So they afford, a higher level of contribution than, say, a traditional or a Roth IRA does. Now, I've also brought out onto your screen 4 different plans that say former employer. A 401k plan, that's a for-profit corporate type of plan. 403b, often used by charitable organizations or nonprofits. TSAs are tax-sheltered annuities, and TSPs are thrift savings plans. So if you were formerly employed and participated in one of these types of plans with your employer, you may be able to move that money out of the plan and into a plan that you qualify for now, and then self-direct those monies if you wish. Now, I will say that if you are currently employed and participating in one of these types of plans, you will need to go to your plan administrator and see if you are eligible to move any money out of their plan into your own plan, which you could self-direct. So all of those types of monies are traditional types of money. They aren't Roth. So if you did have contributions in a 401k plan and don't work at that employer anymore, you could move that into a traditional IRA if you wanted to. There is also the opportunity potentially to turn traditional IRA funds into a Roth IRA. And I would suggest, if you're interested in doing that, talking with your tax advisor. if you earn a certain amount, you may not be eligible to open a new Roth IRA, but there is the possibility of converting traditional funds into Roth funds if you'd like that tax-free earning possibility inside a Roth account. So again, back to these 4 plans. If you no longer work for the employer, then you can move that money out into a plan that you currently qualify for. So something to consider. I also have brought out onto the screen solo 401k plan. Sometimes this is called a uni plan or a solo K. It's really a newer type of plan that was set up as a 401k type of plan, but for a sole proprietor, someone who's in business for themselves, by themselves, or with a spouse. A spouse can also be in the same business. And what this type of plan does, it's got some great benefits for a sole proprietor. It affords you to, have retirement plan on a business similar to if it was a 401k. It does have you as a sole proprietor are both employer and employee, so you can make both types of contributions into a solo 401k. You can also set up the plan so that there's a loan provision. And the interesting thing about the loan provision is it's not limited to a loan for business purposes. The loan can actually be for any purposes, personal purposes, as long as it is paid back on time with interest. It doesn't matter what the loan is for. So that's a nice feature for a small business owner. The solo 401k also can have written into its provisions a Roth provision, so that the employee portion of the contributions can be designated as Roth funds. So if you are a sole proprietor, and it doesn't actually matter if you are a Schedule C sole proprietor or a W-2 type of business, either one, you can set up a solo 401k. Now, how your contributions would be calculated are dependent upon how you are set up as sole proprietor or a W-2 employee. So that you would want to discuss with your tax accountant. But if you are a small business owner, really a sole proprietor, that might be an option that you would want to look into. And if you would like to, we can give you more information about that as well. So now I've talked about some of the different types of plans that you might have, and that you could have a self-directing plan with one of these types of accounts. Let's talk a little bit about some of the different types of investment options that are open to you when you are in a self-directing mode, working with a self-directing company. So really, as I mentioned earlier, anything that is permissible by law, by the IRS rules or the ERISA rules that cover retirement accounts. So real estate is a very important type of investment that many folks would like to have in their retirement account. And there are lots of different types of real estate that you could own in your retirement account. So single or multifamily homes, vacation investment property. Now, I want you to notice the word investment there. It does need to be a property that you are holding for investment, not one that you own down in Myrtle Beach and you take your family there in the summertime to vacation. It cannot be used personally. So it does need to be an investment property. You can also invest in tax liens. Now, that's not actually purchasing real estate, but it is purchasing a tax lien when someone was unable to pay the taxes on their real estate. You can actually purchase that lien and earn interest on that debt. And if they don't pay off that tax, those taxes, then you can actually foreclose on a tax lien, and you could own the property. You could actually come to own the property if the taxes were not paid. But a tax lien is really for earning interest. That's the primary purpose of investing in that. Raw land, building lots. So it doesn't even have to be an actual building. You can actually purchase building lots in your retirement account. Commercial buildings. Now you possibly wouldn't have sufficient funds in your account to outright purchase a commercial building, but you can always partner with other investors and co-own a commercial type of property. And that is what a real estate syndication would be, a number of investors coming together to invest in some type of a real estate transaction. You can also invest in mortgages and loans. So you can purchase a mortgage, which obviously is likely foreclosable as well. So ultimately, if the mortgage isn't paid, you could foreclose on that property and may end up owning the property in your retirement account. Or you can make an outright loan. Could be a promissory note, could be real estate backed loan. I know that there are real estate investors who are looking for funds to make their investments. And so you could work with a real estate investor and lend them money for that type of an investment. Private business investments. You can actually invest in a business. Now, I will say that if you invest in a business, you do need to be cautious. You can't work in that business. It does have to be a passive business investment. So you can earn from a business investment. It could be a loan to the business where you're earning interest. It could be the type of an investment where your retirement account is actually a part owner, so you are earning from the earnings of the business. So that's a possibility in your retirement account. There is also precious metal investing that can become popular, and sometimes when the markets are kind of fluctuating, some people like to invest in precious metals. So there's certain types of metals and fineness standards that can be met, but you can own precious metals in your retirement account. You can also invest in the Forex market. Options and futures are also possible investments. And then, of course, in a self-directed account, you can also have own stocks and bonds and mutual funds. So you can see from this listing that with a self-directed retirement account, you are really able to diversify the assets that you hold. Very different types of asset types and classes that you are able to own in a self-directed account. So those are some of the investment options that are available to you. Now, I do want to talk a little bit about the guidelines for self-directing your retirement account. And let me just say that these guidelines, these rules, they apply to all retirement accounts, whether it's self-directed or not. So these are just basic rules that the IRS has said we must comply with if we are investing in a retirement account. Again, because your retirement account is given tax preferential treatment. So there are some rules that will need to be followed to maintain that tax preferential treatment. So first off, there are some assets that are prohibited that you may not own in a retirement account. And the first one is life insurance contracts. Now, I will say there is one exception to this. If you have a solo 401k plan, then a life insurance contract is a permissible asset in that solo 401k plan. Often, as a sole proprietor, you are the business, so having a life insurance contract on you can be some protection for your business. So life insurance contracts are permitted in solo or uni Ks, but that's the only place. And then another type of prohibited asset, not allowed, are collectibles. So this would be things that collectors collect. Rugs, beautiful, maybe Persian rugs, works of art, fine art, stamp collections, coin collections. Now, when I say coins here, I mean coin collections as differentiated from precious metal coins that are permissible. So these are collectible coins. So they are not allowed as assets in retirement accounts. In addition to the prohibition of some assets, there are also some transactions that are not allowed. So let's take a look at what those might be. First off, the transactions that you engage in your retirement account do need to be for the exclusive benefit of the plan. You can't be using your retirement plan money to benefit you personally or to benefit a family member or somebody else. Your retirement plan is given preferential tax treatment because it is meant to benefit you when you reach retirement age. So the transactions that you're engaging in need to be for the purpose of growing your retirement account value. Some other things you cannot do. You cannot borrow from your retirement plan. So you personally can't borrow money from your retirement plan. Now your retirement plan can loan money to others, but not to you. You can't borrow money from your retirement plan. You also cannot pledge your retirement plan assets to secure a personal loan. And I say pledge, meaning they are collateral. I have seen some personal loan applications that ask for retirement plan information, which isn't a problem as long as the retirement plan isn't collateral for that loan. You can't use it to pledge for a personal loan. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. So let me explain when that might even come into play. If you would like to invest in a piece of realty in your retirement account, but you have insufficient funds to purchase that property, your retirement account can get a loan for purchase that property. But it cannot be a personally guaranteed loan. It must be what's called a non-recourse loan. It's more like a business loan, and a non-recourse means that the lender, if your retirement plan defaults on the loan, only has recourse to that property for repayment of the loan. So there's no other recourse. That's where the terminology of non-recourse comes in. So your retirement account can get a loan, but you cannot personally guarantee a loan for your retirement account. So that's kind of a nuance you want to be aware of, especially if you're thinking about real estate investing and you may need to get a loan to be able to purchase a particular property. Another prohibition is that you cannot engage in any transaction in your retirement account if it will benefit a disqualified person. So you kind of need to know now who are disqualified persons. And you'll see the first person I bring up on the slide is you. You are a disqualified person to your retirement account. You're two separate entities. You are a person, your retirement account is a retirement account. So you cannot engage in a direct transaction between you and your retirement account. And if you are married, this includes your spouse. Your spouse cannot engage in a direct transaction with your retirement account. There are some other family members who are also disqualified. Ascendants, so that means your parents, your grandparents, your great-grandparents on up the line, they're all disqualified. Your children, your descendants, your children, your grandchildren, your great-grandchildren on down the line are also disqualified persons to your retirement account. However, lateral family members are not disqualified. I don't know why, but they aren't. So lateral family members are brothers and sisters, aunts and uncles, nieces and nephews, first cousins, second cousins, 14th cousins. Those are all lateral family members, and they are not disqualified persons to your retirement account. So let me give you an example. Let's say your spouse owns a vacation rental property in Myrtle Beach. Your retirement account cannot purchase it from your spouse. If your father owns it, your retirement account cannot purchase it from your father. If your daughter owns it, it's a no. However, if your brother or sister own it, then your retirement account could purchase it from them. So you just want to be aware of these nuances and who who parties can be part of a transaction and who cannot be. There are also two entities who are disqualified persons. Any company, and it doesn't matter if it's an LLC or an S Corp or whatever, if you are a majority shareholder in that company, it's a disqualified person to your retirement account. Also, any company, if you're an officer, a director, or a highly compensated employee. So let me give you another example here. I talk with a lot of real estate investors who run their investing businesses through a company. Oftentimes it's an S Corp, sometimes it's an LLC, but they are the majority shareholder, and they're also usually an officer. So if that real estate company owns a property, then their retirement account cannot purchase that property from that company. So we'll talk a little bit more about some ways to work, not around that, but to accommodate that if you structure a transaction properly. But in terms of the basic rule, these are disqualified persons and entities to your retirement account. Pardon me. Now, I want to talk with you a little bit about the structure that STC uses for each of our clients' accounts and why we use it. We use an LLC structure, and this means that for each client account, we actually set up a distinct LLC that is owned by the retirement account, and it becomes the investing entity for your retirement account. It's not a generic business LLC. It's a very specialized one. Its operating agreement and its articles of incorporation are all written in such a way that it's designed to be owned by a retirement account. So it's a specialized type of LLC that we set up for you. And the reason that we use this structure is because it gives our clients maximum flexibility in structuring transactions. And you can get very complex in transactions. You might want to have multiple parties in the ownership of an asset, your retirement account being one of them. You might also want to have leverage. In other words, have a loan, a piece of real estate that you have a loan on. You might also have one of the parties to this transaction doing some kind of work, service with this real estate property. So using an LLC structure, you can accommodate complex transactions. It gives a lot of flexibility. It does also provide an additional layer of asset protection. I mean, it is truly a limited liability company, which is one of the benefits of an LLC. It gives you checkbook control over your retirement account. Now, I know a checkbook control is a term that gets talked about a lot in self-directing, and some companies give their clients the checkbook for their retirement account, and so the client can go and write checks on behalf of their retirement account and purchase assets. Now, there is a bit of a danger in that. If you are not an expert in all of the nuances and the rules related to retirement account investing, you can potentially invest in a prohibited transaction, and the penalties for doing that can be severe, up to forfeiting your retirement account and it suddenly becoming non-retirement account and all income taxable to you. So our checkbook control is we review your transactions, and then we can same day or next business day fund your transactions. So what you do is you can send us your information and we will immediately review it, and if there's no question about it, it looks like it's structured properly, the funding is going to be fine, it's titled properly, then we can same day or next business day fund that transaction for you. So the benefit to you is that you have experts looking over your transaction. So it's kind of like having a checkbook, but you have some protection from our experts. So it gives you immediate response to investment opportunities. with the protection of somebody reviewing your transaction. Another benefit is that it does simplify asset titling. When you, for example, real estate investing, there's a closing that has to be gone through in order to own a real estate asset. With our LLC structure, you, as the retirement account owner, can go to the closing and sign the closing documents on behalf of your retirement account. Without this structure, other companies, you would have to send closing documents to their corporate office, where someone has to review those and sign off and then get them back to you. And that can cause delays and potentially problems with sellers. So this simplifies your asset titling. You go to closing and you send us copies of the closing documents for your retirement account. Using this structure also eases pooling with other funding sources, meaning simplifies, makes it easier to co-own an asset with others. So let's take a little look here at our retirement plan structure so you can kind of see what I mean when I say that. If you look on the upper left, you'll see current custodian. So this would be where your funds are currently held, assuming that you have an account. And let's say you decide that you want to open an account with STC. So you would complete some paperwork that would direct your current custodian to transfer or roll over funds, either all of your funds or some of your funds, to our self-directed custodian. Now, while that's happening, our operating department is working to set up this retirement plan LLC that's going to become your investing vehicle. Now, that LLC can be incorporated in any state that you like, and you can talk to our operations department and they can help you determine which state would be best for the type of investing you're planning to do and where you might live. So once the funds reach our custodian and the LLC is set up in the state of your choice, then your funds move to a bank account that your LLC has access to, and the membership interest in this LLC is held by the self-direct custodian, and then you're ready to begin investing. So now your setup's complete, that top little area, and now in this scenario you have 3 investments in your retirement account. Investments 1 and 2 are wholly owned by your retirement account. You're the sole owner, the sole investor. But look at investment 3. There are 4 investors. Your retirement plan, and then there's your father and your daughter and some of your personal money. Now, you may remember I just told you that your father and your daughter and you personally were disqualified persons to your retirement account, and that's true, they are. But if this is structured properly, and you'll see this yellow box at the bottom, if you are co-investors, your retirement account, your father, your daughter, your personal money, at the inception of the purchase transaction, then this is an allowable, viable transaction and does not violate the disqualified person rule. So what this means for you is, and as an example, let's say you find a real estate property that you would like to own. Maybe it's a small apartment rental property in a college town, but your retirement fund has insufficient funds to fully own it. So you can have co-owners with this. Your father, your daughter, some of your personal money, and your retirement money can all co-invest and own that small apartment building. So just something to consider in branching out and thinking about diversifying your real estate holdings. This is a possibility, and we can help you get this structure set up and help you know how to title the documents and all of those kinds of things if you want to do this type of a transaction. It's kind of our specialty. Okay, so I do want to, before I move into the Q&A session, I do want to talk about what STC does. We are a full-service, self-directed retirement plan administrator. So we complete for each of our clients' accounts that retirement account LLC structure that I just explained to you. We offer that protected checkbook control, which means that our client services department is looking at your transactions. You can call them, email them, send them documents, talk with them, review transactions in advance to make sure that you are in compliance with the rules. But we offer that protected checkbook control. We do have CPAs and attorneys available to answer technical questions that might arise. We have unlimited guidance on transaction compliance. Again, our customer service department is always available, well, during office hours, to help you with any questions or concerns. We also handle all of the back office support. There's a lot of administrative stuff that has to be done with retirement account bookkeeping. So we will maintain the LLC financial statements for your retirement account. You'll actually be able to kind of run it like a company. You'll see a statement of cash flow. You'll see, the assets that you have, the ins and outs of your money. So those are available online to you as a client. We will supervise the regulatory reporting that is required, and we will also oversee the required annual valuation. So in essence, we see our job as to be do all of the administrative support and help you with compliance, transaction compliance, so that you don't have to be an expert and you don't have to do the bookkeeping, which really frees you up to focus on finding the best investments for your retirement account. So that is the full service approach that we offer. Now, I am going to open the floor for your questions and answers. If you would like to type questions into the little question box that is on your screen, I'm actually going to open that up. So please type me your questions. And while you are doing that, I will also give you just a little bit more information, waiting for some. I did get some questions in advance too, actually. I have a few of them. So type your questions to me, and then, maybe at this point you want to open a self-directed account. We'd be happy to get you documents, paperwork to get that started. Maybe you have clients or colleagues. Maybe you are in some kind of financial field where you would like to tell your clients or your colleagues about self-direction. We would be happy to give them information. And maybe you just need more information. So if any of those is the case, our website is stcira.com. There's a great deal of information there. Our corporate office number is on your screen, and you can reach me directly at my email, jknight@stcira.com. So please do get in touch with us. We do want to be able to help you with any of your questions. Okay, let me open up my question box, and we will get to answering what you have put out here. Okay. And it looks like I've got 10 minutes or so to answer questions. So, okay, if I want to purchase a bank-owned house, okay, so this is real estate that's been foreclosed on by the bank-owned house. They often require verification funds. How would I verify funds that are in my self-directed IRA? Well, what you would do is you would get in touch with our client services department, and you would tell them that you needed a verification of funds, and you would tell client services the dollar amount up to the full value of your available monies in your account with us. Tell them the dollar amount that you want in this letter, and then we will prepare that letter for you and get that email that right back to you. And I say that we ask you to tell us how much you want the letter to say, because you might not want them to know the full amount that you have available for investing. So you can tell us up to the full value. So we can give you a verification of funds letter. Okay, do I have to have earned income in order to contribute to my IRA? Does money earned from rental income qualify? You do have to have earned income in order to make contributions. Passive income, like interest income, passive investment income is not considered earned income. Can I provide startup capital for a new business, such as a retail clothing operation or an auto repair shop? Yes, this is a qualified yes. It depends on who other parties are. Of course, your retirement account could not do this if a disqualified person owns this business. But let's say it's your brother. Your brother's not a disqualified party, and your brother is opening an auto repair shop. Yes, your retirement account could provide startup working capital for that business. And then you would want to decide with your brother what the terms of that, basically it's a loan. Either you're getting interest on the monies that you're investing, or your retirement account is a part owner, and so your retirement account is going to be receiving a pro rata share of the earnings from this auto repair shop. Now, one thing to keep in mind, depending on the type of investment you're making, there is sometimes a taxable consequence that can come into play. Generally, passive investments in your retirement account are no tax consequence. That's the benefit of retirement account investing. But there is a tax code, UBIT, unrelated business income tax, that potentially could come into play with a business investment. And if you use leverage, in other words, get a loan to own realty, then there is a potential for UDFI, unrelated debt financed income, which is taxable. It's a subset of UBIT. So those are, you can do those things, but you may want to keep in mind that they could trigger UBIT or UDFI. And that would be something you would want to discuss with your tax preparer. If you have general terms of an investment as a client, you could talk with our client services department, and they might be able to assist you to determine if that was potentially going to come into play or not. Okay. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. We definitely have clients who, like maybe between investments, maybe they owned an investment and then they sold it. So now they have a big chunk of cash again in their account, and they don't want to just leave it completely idle while they're looking for their next investment. So what they do is they actually open a brokerage account in the name of their IRA LLC. So it does need to be a business brokerage account, and it does need to be in the name of the IRA LLC. And then you would direct STC to send funds to that brokerage account. And then you could go into that brokerage account and actively trade, buy, sell. What we would need from you, though, is we would need to see monthly statements on that account, because we need to verify that no money has gone in or come out that didn't go through STC, that didn't go through your retirement account, that nothing was sent to you directly. Because remember, it's a piece of your retirement account. But yes, you can certainly do that. You can have a self-managed stock brokerage account. Are in-laws prohibited to loan money to? Yes, we believe that they are. We said that your parents were disqualified persons, and generally in the eyes of the law, your spouse and you are one. So your in-laws would also be considered disqualified persons. Okay, let's see. I see a couple more questions here. Okay, a traditional IRA requires the owner to begin withdrawals at age 72. Let me just make a qualification here. That RMD, required minimum distribution age, increases in 2023, so it goes up to age 73 from the Secure Act that was enacted. So it's now 73. If one owns real estate in their account, is it required to sell it at some point in time? And I guess this means in order to take an RMD. If income from the property exceeds the allowable contribution, how is that handled? Okay, that's a completely separate question, so I will answer that in a moment. But okay, so let's just say you have reached the age of 72 in 2022. You're required to take a minimum distribution, and you have insufficient cash in your retirement account to make a cash withdrawal in the required amount. You do not have to sell the property. You can, but you don't have to. If you don't want to, what can happen is you can have your property appraised as of December 31st. That's the date the value is established for the required minimum distribution, the calculation. So you would have your property appraised on December 31st, and then that value, that new fair market value, what you can do is you can distribute part of the ownership of the property to yourself as the required minimum distribution. So it would require a retitling of the property into two owners' name now. Your retirement account as one owner and you personally as a co-owner. And your required minimum distribution value would now be owned by you personally. And then that would be you're taking the distribution. It's an in-kind distribution, and you are still taking the value. So that is a possibility. It requires a little extra effort, but you don't have to sell the property. And just to add on to that, like if you were holding that property, it was say a rental property, and so your retirement account was earning rental income. If you do this, now you have a co-owner, you personally, in your retirement account, then now rental income comes to both your retirement account and to you personally in your pro rata share of ownership. So that would be another nuance of that situation. Now, the second part of that question says, if income from the property exceeds the allowable contribution, how is that handled? Okay, there's a little bit of a misunderstanding in this question. Income earned in a retirement account is something completely separate from contributions. Contributions are made into a retirement account annually, if you wish, from your earned income. Once the money is in the retirement account, it can earn as much as possible, and we hope lots and lots. So there is no limit on the amount of earnings within a retirement account. The limit is on what you can contribute to the retirement account. Okay, let's see. What is the time frame to get my account up and running? Okay, typically, we do have a little bit longer setup time because of the creation of this LLC that becomes your investing entity. So our setup time frame typically takes 4 to 6 weeks from the time that we get the original paperwork. And during that setup time frame, our operating department is going to coordinate the transfer of your retirement assets from your current custodian to our custodian, to your new custodian. And then we'll also be creating that LLC in the state of your choice. And then once those funds have moved to your new custodian, our custodian, and into the bank account, then you're really completely set up and ready to start investing. Now, the operations department is going to keep you updated throughout that process. You're going to get emails that will tell you each step, when each step is completed, and then once your new account is funded with those monies that have been received from your old account, then you'll receive a confirmation email. You'll also get a binder with all of your signed documents with instructions on how to make contributions and withdrawals and how paperwork for investing. And of course, everything is also available online as well. So, but it does take a little bit longer for setup because of those different steps. Once your account is fully funded and set up, that's when we have this 24, same day or next business day funding of your investments. And, you don't have to mail paperwork to us. You can email it, fax it. Our client services department will pick up those transactions right away and will review them and try to get them funded same day if possible. Okay, I just had another question come in. Let me see if I can read this. Okay, how does STC determine the values of real estate in my self-directed IRA for annual reporting? All right, when you purchase a property, that price that you pay is the value of your property until it's required to be appraised. So it will remain that value, and as you earn money on it, that money will increase the value of your account, but that will be a cash in your account. So that will be separate from the value of the real estate in your property. Once an appraisal is required for some reason, then that will become the new fair market value in your retirement account. Okay. Let me see if I have, I might have gotten one more question. Let me see here. Okay, this is another RMD question, required minimum distribution. Is the required minimum distribution based on total assets or cash in hand or equity? Okay, well, first, let me just do a little bit. I'm not a tax accountant, so you do need to check with your tax accountant if you are required to take a minimum distribution. But generally speaking, the RMD is calculated for each of your accounts. So if you have multiple accounts, it's going to be calculated on the value, December 31st value of all of your accounts together. So all of your accounts. So the RMD is calculated by dividing that prior December 31st balance by a life expectancy factor that the IRS publishes, and your tax person will help you with that. If you own real estate, then the fair market value of that property will be included in the balance of the account for purposes of calculating the RMD. So if you are 72 in 2022, 73 in 2023, then your property will need to be appraised on December 31st because a required minimum distribution must be made, and that will be based on the fair market value. And again, if you have more than one account, that RMD is calculated on the combined balances of your accounts. But I should also mention that the distribution can be taken from a single account if you wish. So just to elaborate on, let's say you have a property in a self-directed account, but then you also have another retirement account that has stocks and bonds and mutual funds in it. If you're required to take an RMD, you'd have to get your property appraised so that fair market value could be included in the calculation. But then you could take the RMD from your stock retirement account. You could liquidate some stocks and take out the cash there. So there are different nuances that would be available to you. So again, you will want to check with your tax person. Let me see if any more questions came in. Okay, I've got two more. Can I purchase a property with funds in my retirement account and then sell that property and hold the mortgage for the new buyer in my account? Very good question. So you own the property, your retirement account owns the property. Someone wants to buy it from you, but they want you to basically sell or finance it. Yes, your retirement account can do that as long as that buyer is not a disqualified person. So, and plus, it couldn't be a disqualified person to sell it to them. But yes, you could do that, and then you would likely want to have the property as collateral, so you'd have a lien on that property. You would set the terms of that mortgage. So yes, as long as the buyer's not a disqualified person. And here's our last question before I close out. Can my retirement account purchase additional interest in a property I'm already invested in? Okay, now the way that's worded, I'm assuming I'm already invested in means I'm personally invested in. So if you are personally invested in a property, no, your retirement account could not purchase some of that, because that would violate that disqualified person rule. Now, if we're talking about a property that your retirement account owns and there aren't any, there's no co-ownership with otherwise disqualified persons, then it's possible your retirement account could purchase a larger interest in that investment if the seller made that available. But you couldn't do that if you had partnered with otherwise disqualified persons at the inception of the transaction. Got a little complicated there, but anyway, basically pretty much the answer is going to be no. And if you have a complicated situation like that as a client, you can call our client services department, because we like to help you with those kind of questions. So again, thank you so much for joining me this evening. Please do get in touch if you need additional information. Check out our website. Let us know if you would like paperwork, if you are interested in opening an account. And I do hope that you will join us for our next educational webinar next month. Generally, they are the first Wednesday of the month. If you received an invitation to this one, you will likely get an invitation to the next one, and you can always also sign up on our website. Thank you so much. Have a great night. Bye.